We will explain what capital budgeting is and why companies use it when making strategic decisions. Then we will continue by introducing two fundamental notions for those of you who need a quick refresher: the time value of money and discounting cash flows. Once we have covered these topics, we will be ready to introduce a few techniques that allow us to answer the two most important questions in capital budgeting. Does the investment make sense? And is this the best alternative we have? We'll study the payback method with the NPV and IRR techniques. Then we'll talk about the typical discount rates companies use to measure a desired rate of return and account for risk and the time value of money. We'll also learn about the cost of equity, cost of debt, and the weighted average cost of return, WACC. At the end, we'll be able to wrap it up with a great example featuring a company that tries to assess an investment opportunity and compares it with other alternatives. Sounds great, right? Okay, let's dive straight in and learn more about capital budgeting. Capital budgeting, also known as capital asset planning, is a term relating to the decision-making process companies go through when they must determine whether to invest in a specific long-term initiative or asset. In addition, capital budgeting is used as a tool allowing company executives to compare alternatives they have when making strategic decisions. Let's provide a few examples of decisions that merit an extensive capital budgeting investment analysis. We will typically use capital budgeting techniques when assessing the investment in a new production plant, the acquisition of a new ERP system, R&D activities related to a new project, expanding our existing warehouse, purchase or leasing new vehicles, invest a significant amount in employee training, and so on. These projects differ greatly from each other, but have a few traits in common. All are long-term and represent decisions that will shape the company's success in the years to come. In addition, these initiatives require a significant initial investment, and making the right calls becomes even more important, as no investments can be easily reversed. Okay, great. So, capital budgeting is an assessment method we apply when we must decide on an investment for which a large amount of money and risk is involved, decisions are irreversible, and might impact our business for the years to come. Awesome! When we try to assess a project's feasibility, we must consider three main parameters: capital that will be invested, the project's timing, and the return we could expect. The core principle of finance is that money today is more valuable than money tomorrow. The rationale behind it is that money we receive today has a potential earning capacity. This is why every person would prefer to receive money sooner rather than later. Hence, timing is one of the most important topics when we talk about money. Let's imagine we will be paid $1,000, and we are offered to choose whether to receive it today or after 1 year. If we choose to receive the money today, we can go to the nearest bank and deposit it for 1 year. Given that the bank wants to attract such deposits, it will pay interest on our money. Let's imagine the bank would pay us 3% if we leave our money there for a year. In 1 year, we will collect our initial $1,000 and we will be paid 3% of $1,000. We will have $1,030 total. Had we received $1,000 after 1 year, we would have missed the opportunity to earn the interest of $30. Money today offers more opportunities than money tomorrow. Okay, great. How do we apply this concept in our case? When we build a plant or invest in R&D today, we commit money that is available now to reap the benefits later. That's what we do. Ideally, we invest money today and hope we'll be able to get more money later. A capital budgeting exercise aims to answer the question, is it worth investing X today if we expect to obtain X plus Y a year from now? First, the analysis will show us whether the project will create or destroy value once we consider the time value of money. And second, it would allow us to compare different investment alternatives and see which one offers a higher rate of return. We already know money today is more valuable than money tomorrow. We should remember this when adding sums of money received at different points in time. Imagine the following cash flows. Which one is preferable? Do we want to receive 100 in year 2 and 110 in year 3? Or 100 in year 1 and 100 in year 2? If we simply do the math, 210 is better than 200, so we should pick the first option. This isn't true after we consider the time value of money. In finance, we should never add sums of money without considering the timing when the cash flows occur. This is very, very important. If I deposited $100 in a bank, I would expect the bank to compensate me for the right to use my money. Let's say the money will stay in the bank for a year, and after 1 year, the bank will repay me the initial amount plus an interest of 3%. So we will have future value equals present value times 1 plus I, where present value is the amount we are depositing and I is the interest rate the bank will pay us for depositing our money. We would have future value equals 100 times 1 plus 3% equals 103. After 1 year, we will receive $103. What if we want to find the present value of a future cash flow? How do we find how much a cash flow we will receive is worth? Starting from the equation future value equals present value times 1 plus I, we can simply divide by 1 plus I, and we'll obtain that the present value equals future value divided by 1 plus I. When we account for the time value of money in this way, going backwards, we talk about discounting. What if we wanted to make another deposit after year 1 ends? We would have 100 times 1 plus 3%, which is the value at the end of year 1, and it will be deposited for another year, so at the end of year 2, we would have 1 plus 3% times 100 times 1 plus 3% equals future value at year 2. The present value, 100, is equal to the future value divided by 1 plus 3% to the second degree. So when we must discount a future cash flow, that is n years from now, we must divide it by 1 plus I elevated to the nth degree. Now that we learn this, we can go to our first example and calculate which one of the two cash flows has a higher present value. Here are the two sets of cash flows. The first one involves a payment in year 2 that is equal to 100, and another payment in year 3 that is equal to 110. To calculate present value, assuming an interest rate of 10%, we must use the formula we have here. We will have 100 divided by 1 plus 10% to the second degree. We are elevating to the second degree because the cash flow is 2 years from now. Then we will have 110 divided by 1 plus 10% to the third degree, because this is a cash flow in year 3. The present value we will obtain from this equation is 165.3. It's much lower than the simple sum of 100 and 110. Now let's calculate the value of the other set of cash flows. We will have 100 discounted by 1 year plus 100 discounted by 2 years. We obtain that the present value of the second set of cash flows is 173.5. As you can see, by discounting 2 sets of cash flows and obtaining their present value, we can compare them and decide which one is preferable. The selection of the discount rate is important in this calculation. In addition, the timing of cash flows obviously plays an important role too, right? I am sure you'll agree with me that discounting of cash flows looks like a concept that is close to the idea of capital budgeting. Comparing the value of future and present cash flows is the main idea behind the entire exercise. It improves our decision-making process, providing a quantitative means of comparison between different alternatives a company has. Projects consist of an initial capital outlay, which is typically a present value, money we invest now, and then generate a series of cash flows in the future values that must be discounted. Once we discount these future values, we can compare them with the amount that's being invested in the present and calculate a rate of return of the project. A key ingredient in this exercise allowing us to discount future cash flows is the discount rate we will choose. This will be the focus of the next few lessons. Okay, excellent. In this lesson, we'll talk about discount rates. We said that to perform a capital budgeting exercise, we must discount future cash flows and obtain their present value. However, we still must cover a subtle topic, which is the discount rate that should be used for this calculation. Well, that's up to the person carrying out the analysis, but a few alternatives are typically used in different scenarios. Depending on the project we are valuing and the way it will be financed, our discount rate could be the firm's cost of debt, the firm's cost of equity, its weighted average cost of capital, or a hurdle rate chosen by management. Cost of debt. This is the average interest rate the company pays on its borrowings. It makes sense to use the cost of debt as a discounting rate if the entire project is financed with debt. In this case, this is the cost the company sustains to finance the project. Hence, when we use the cost of debt as a discounting rate, we'll be able to compare the investment required now and the present value of the cash flows the project will generate. An alternative discount rate is the company's cost of equity. There are many ways to calculate a company's cost of equity. In this course, we'll apply the one used by investment bankers. It is called the Capital Asset Pricing Model, also known as CAPM. The model was introduced in the 1960s, but remains relevant to this day and age. The capital asset pricing model suggests a company's cost of equity is equal to the risk-free rate plus beta multiplied by the market risk premium. The risk-free rate in an economy is the rate of return that an investor would expect from a financial security that contains zero default risk. The investor buys the security and can be certain he will be repaid on time and in full. In the complicated world of today, very few securities can be considered risk-free, but most practitioners use the yield of a 10-year government bond to approximate this measure. The governments of developed countries have a solid reputation and can be trusted in a 10-year time frame. The rationale behind using a 10-year and not a 3-month bond is that the valuation of the firm is a multi-year exercise. Hence, the risk-free rate used shouldn't reflect a period as short as 3 months. The next component in the calculation is beta. This is a statistical measure. For those of you who love statistics and quant finance, beta can be calculated with the following formula, and it is basically used to show how a financial security behaves regarding the rest of the market. That is why we are dividing its covariance with the rest of the market by the market's variance. If this is confusing, don't worry. Many financial providers calculate a company's beta for you. Let's open P&G's Yahoo Finance profile. As promised, you can immediately see the company's beta. Here it is, almost 0.5, which usually is considered a conservative stock. A beta that is less than 1 indicates the stock is less volatile than the market. A beta of 1 shows the stock is as volatile as the market. If the market gains 1%, it will also gain 1%. If the market loses 5%, it will lose 5%. Stocks that have a beta higher than 1 are considered aggressive and are more volatile than the market. If the market grows 2%, the respective stock will probably earn 2.5 or 3%, and so on. You get it, right? A company's beta will typically have a value ranging between 0 and 2. The next component in CAPM is market risk premium. Theoretically, it is given by the average expected return of the market minus the risk-free rate. Academic research has shown the average market risk premium rate varies between 4.5% and 5.5%, and most practitioners use 5% in their cost of equity calculations. So, we will have the following. The cost of equity in a company is given by the risk-free rate in the economy where it operates, plus the company's beta multiplied by 5%. Cost of equity is not that difficult to calculate, right? You can find the yield of a 10-year U.S. bond in Google. Then we saw that a company's beta is available in platforms like Yahoo Finance and Bloomberg. And finally, we multiply by a constant 5%. Easy, right? If we take a careful look at CAPM, it makes sense. A financial securities return should be composed of 2 parts. First, the risk-free rate of return as a minimum, compensating the investor for the time value of money. And a second component, compensating the investor for the additional risk for holding a security that is not risk-free. The risk is measured by comparing the stock to the rest of the market, and the result is that the riskier the stock, the higher its expected return should be. Brilliant, isn't it? So, this is how we can calculate a company's cost of equity. The CAPM model is one of the most widely accepted academic papers on this topic. We can use the cost of equity as a discounting factor for projects financed entirely with our own funds, with equity. This is an assumption that no debt will be used to finance the project. I'm sure you'll agree that, in practice, projects are not financed with just equity or debt. In 90% of the cases, we'll use a mixture of both. One subtlety we didn't mention in our previous lesson is there can be a difference between a project's beta and a company's beta. This happens when a project is financed with a different amount of leverage than the typical amount of leverage used by the company. Imagine GE wants to build a new appliances production plant that will cost approximately $600 million. It intends to finance the plant with 70% debt and 30% equity. The typical debt we see on the company's balance sheet is around 40%. Its business is highly diversified and isn't representative of the beta of a single industry. Therefore, constructing the plant will have a different risk profile than the rest of the company's business. The greater the debt taken up in a project, the riskier it is, and the higher its beta will be. It isn't theoretically correct to use the company's beta to assess the project under these circumstances. How do we account for that? Well, we must carry out a few manipulations. We must adjust the company's beta for the risk profile of the industry in which the project will be carried out, and for the amount of leverage of the project. A company called X operates exclusively in the appliances production business, has a beta of 0.6, 65% debt on its balance sheet, and a marginal tax rate of 30%. Okay? So, how do we do it? First, we must delever company X's beta. This calculation will calculate a beta independent of the firm's capital structure. To do that, we must multiply company X's levered beta by the following fraction. In our case, this will cause a beta of 0.26. This is company X's unlevered beta independent of the firm's capital structure. So, that's the beta we will expect companies from this industry will have when we don't consider their capital structure. Okay, however, we want to estimate the beta of a specific project, remember? Therefore, I will multiply company X's beta by the same denominator we used earlier. Okay? And this time, the numbers we'll use inside, the company will use 70% debt. And let's assume its marginal tax is 40%. Right. The project-specific beta we obtained is equal to 0.63 approximately. This differs from the company's beta. The reason is that we considered the specific industry to which the project will be related and the concrete debt structure applied by the company. That's a useful technique that will help you when you work on sophisticated capital budgeting cases going forward. Whenever we must assess a project, which will be financed with both debt and equity, we must use a blend of the two discount rates, right? We can't discount the expected cash flows the project will produce with the cost of debt only, if the project is financed with both debt and equity. In the same way, we can't use the cost of equity alone. The discount factor that considers both debt and equity investors is called weighted average cost of capital, or simply known as WACC. It provides a sense of the average opportunity cost sustained by investors for investing their funds in the firm. Let's look at the WACC formula. It has two weighting components: debt divided by the sum of debt and equity divided by the sum of debt and equity. The sum of these two components is equal to 1. This shows us that if a project is prevalently financed with debt, the cost of debt will have a higher weight. And conversely, if a project is financed mainly with equity, the cost of equity will have a higher impact on WACC. We shouldn't forget to mention that the cost of debt component includes a third factor, 1 minus T, that considers the fact that interest expenses are tax-deductible, and the cost of debt is lower than it seems as it provides borrowers with a tax shield. Now that we know how to find a firm's cost of equity and a firm's cost of debt, it is a piece of cake to calculate its weighted average cost of capital. That's awesome. We are making excellent progress. In our next video, we'll discuss different capital budgeting techniques. Thanks for watching. Okay, great. We are doing well. So far, we learned what capital budgeting is, why companies use it as a part of their strategic decision-making process, and why it is critical to get it right. We learned about the time value of money, how to discount cash flows, which discount rates to use, and how to apply the main capital budgeting techniques used by practitioners. That's perfect. In this lesson, we'll continue the topic, trying to dig deeper. Let's describe the typical sequence of cash flows we can expect in a capital budgeting exercise. Imagine our company intends to build a plant assembling bicycles, and that the plant would cost an estimated $25 million. The first cash flow we would have would be the capital outflow of $25 million. We must invest to build up the fixed asset. Once the plant is ready, working capital would be needed, right? We can't simply assemble bicycles without buying some parts and holding a certain amount of inventory. It is reasonable to expect that every project like this one would require a certain amount of working capital, which would be blocked throughout the project's lifetime. So that's an additional investment required. Imagine the company building a new bicycle assembly plant has an old one. Therefore, it can sell some of the equipment there, and this will cause a positive cash inflow. The budget for the new plant comprises the acquisition of new machinery, and this would allow us to sell old assets. Once the plant is ready, the company will assemble bicycles and will have recurring operating cash flows from companies buying and distributing these bicycles. Recurring operating cash flows are the main source of income that will determine whether this will be a successful project. The more bicycles are assembled, and the higher the efficiency with which this is done in the plant, the higher the cash flows realized throughout the plant's life, and the higher the chances of the project succeeding. If we assume the plant will be used for 15 years, and after that the company must build a new plant, we must consider the fact that the plant we are about to build will have a significant residual value 15 years from now. Perhaps some of the machinery will be sold 15 years from now. Other items will be recycled, or even better, someone could be interested in buying the plant. Okay, did we forget something? Oh, right. Once the project life ends, the working capital we had invested at the beginning to buy inventory parts for bicycles would be freed up. Perfect. These are the main events that have a cash impact and that we must plan for in a capital budgeting exercise. In our next lesson, we'll discuss how to forecast these items. That's exciting, right? In the previous lesson, we discussed the typical cash flows we must plan when performing a capital budgeting exercise. And that's a solid foundation that brings us one step closer to performing a sophisticated capital budgeting exercise. However, to do that, we must be able to forecast each item and create a numerical simulation of the insights our team has about the project. First, we must estimate the actual investment needed for the project. Depending on whether we plan to build a plant, invest in IT, or something else, we must make sure we have a good idea about the money needed to complete the project. Things become easier if we sign a contract with a third party and they bear the risks associated with cost overruns. Otherwise, if we invest in building a new facility and construction becomes more expensive than initially thought, the entire project assessment we have prepared with the capital budgeting exercise becomes irrelevant. So it is key to understand whether the initial investment is a fixed amount or an estimation that will likely change once the project starts. If we are in the second scenario, we should perform a sensitivity analysis that would allow decision makers to see how the project's financials will look in different states of the world, like creating different scenarios in which the plant we are building costs different amounts. Once the project has been completed, it will serve its purpose. In our example from earlier, the plant will produce bicycles and generate money. How much, though? Well, here's the tough part. We must estimate how much money will be made before the project starts. This involves assessing the demand for bicycles and making an assumption about the price at which they will be sold, not only a year from now, but throughout the life of the entire project. By estimating the potential demand and the price at which the company can sell bicycles, we'll obtain a projection of revenue figures. Then comes the matter of estimating expenses. Here, we can have plenty of unknowns. The price of bicycle parts our plant uses could change. Cost of labor increases over time. Plus, there can be other unexpected factors along the way. The important thing is to model expenses in sync with revenues and respect the assumptions we've made when forecasting revenues. Most practitioners prefer modeling COGS and OPEX costs as a percentage of revenue, and this can be a potentially viable approach, especially in the long run. When we must forecast 5 or more years ahead, it is difficult and impractical to do it for each line item. Right. Once we've modeled revenues and COGS, we must think about the cash flow effect that will derive from balance sheet items. We already said working capital investment will likely represent significant cash tied up into the project. Inventory, trade receivables, and trade payables are 3 items we must consider. The days technique we studied earlier would allow us to forecast these items in line with revenues and COGS we've assumed earlier. Depending on the project your company is working for, you may want to consider the impact of other balance sheet items too. For example, in certain legislations, we could deduct certain costs earlier, which will give rise to deferred tax liabilities. If so, and the amount is serious, we should take deferred taxes into consideration when coming up with cash flow estimations. At this point, we've estimated all P&L and balance sheet items necessary for calculating recurring cash flows. And this takes us to the end of our project, when we can expect 2 types of inflows. One deriving from selling the residual assets related to our project, and another from the freeing up of working capital. The terminal disposal price of the asset we've invested in is determined by its degree of obsolescence. If this is an asset that ages quickly, then the terminal price will be a small fraction of its original price. However, it is also possible to have an asset that is still valuable and can be sold at a good price. Usually, companies use the services of specialized personnel who can value such assets and come up with a concrete value. For your reference, in some models, terminal value could be as low as 3 or 5%. While in others, it can be even 40%. It depends on the type of asset we are considering. The estimation of working capital freed up at the end is easy. We've projected working capital values until the end of the project's useful life. The amount of capital that will be freed up at the end is the same as the amount of capital we used in the last year of projections. Okay, great. This is how we come up with the numbers that would allow us to carry out a proper capital budgeting exercise. Thanks for watching this lesson.